Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about JBLU. Now, JetBlue Airways Corporation, ticker JBLU, has been in the investment crosshairs for years now. Following the collapse of the Spirit merger and the implementation of their big jet forward strategy, the stock has shown some remarkable, if volatile, movement. As of December 5th, 2025, it closed near $4.79, commanding a market cap of roughly, $1.74 billion? This recent volatility puts us at a really critical juncture.
A critical juncture, yes, and I think one that's defined by a deep uncertainty about the source of this recent buoyancy. On that same day, December 5th, we saw a noticeable, I think it was a 3.01% gain, and that was accompanied by heavy volume, around 17.5 million shares traded. So the central question for any, sophisticated investor is clear. Is this upward price movement a rational market validation that JetBlue has finally engineered a successful turnaround and earned a survivor premium? Or is it, just a speculative spike masking severe fundamental risks, positioning the stock as a long-term value trap?
My position is that the market is finally beginning to price in the success of the operational pivot. I think the upward movement reflects genuine strategic validation. JetBlue is stabilizing its internal metrics, and maybe more importantly, the industry structure is rationalizing in its favor. That creates a crucial survivor premium. They are actually executing on their plan, and they're doing it in a less competitive landscape.
I'm afraid I just can't agree that this appreciation is anything more than, tenuous speculation. It's primarily fueled by external events. I would argue that the stock's consistently low price is a direct function of a deep, fundamental value compression and, frankly, a massive debt overhang. Any rally is extremely fragile. It's exposed to institutional skepticism and hedging, which means the stock isn't stabilizing. It's just bouncing along a very precarious floor, one that's defined by its leverage.
Okay, but the best evidence for strategic validation comes directly from the Q3 2025 earnings report. That report clearly showed the JetForward strategy taking hold. It confirmed they are on track to achieve incremental EBIT benefits targeting $290 million for 2025. That is management delivering on internal promises. But the most compelling factor is external. The anticipated and now realized capacity constriction within the ultra-low-cost carrier, the ULCC segment. Spirit Airlines, under Chapter 11, is reducing its capacity by approximately 20% for the entirety of 2026. This retraction provides an undeniable structural benefit to JetBlue's yield, its revenue per available seat mile, or RAS, especially in those high-overlap leisure markets, Florida and San Juan. When your chief rival shrinks by 1/5, your pricing power just fundamentally improves.
And I acknowledge the substantial tailwind that Spirit's contraction provides. I really do. But we can't let operational improvements distract us from the core structural risk here, which is the balance sheet. When we compare JetBlue's total debt, which sits at roughly $9.42 billion, against its meager $1.74 billion market cap, the picture is just stark. The equity is a small, highly fragile sliver underneath a colossal stack of leverage. This capital structure, it fundamentally defines the risk profile of the stock, irrespective of whether management hits a $290 million EBIT target. That leverage stack dictates that shareholders are disproportionately exposed to macro shocks, and what's more, institutional positioning reflects this fear. The short interest remains highly elevated at over 20% of the float. And when we look at dark pool activity, the trades executed off-exchange, which account for over 31% of recent volume, it strongly signals persistent institutional skepticism and defensive hedging against this high-leveraged entity.
I accept the gravity of that $9.42 billion debt figure, but I would argue that the operational cleanup, the internal execution, demonstrates management's ability to mitigate that leverage risk by generating reliable cash flow. The market is recognizing that JetBlue is controlling the elements that are actually within its grasp. Specifically, let's consider the operational metrics. They achieved a significant cost per available seat mile excluding fuel, a CASM ex-fuel beat in Q3 2025. They held that increase to only 3.7%, compared to the midpoint guidance fear of 4.5%. And for our listeners, CASM ex-fuel is the critical metric of operational efficiency. It removes the volatility of fuel prices to show true internal cost control.
And how did they achieve that control?
Well, primarily through operational reliability. They completed over 99% of scheduled flights, which is essential because it drastically reduces those massive cascading IROPS costs, the irregular operations expenses from delays and cancellations. When you stop having operational meltdowns, you save millions. And you couple that with the structural change of retiring the high-cost older E190 fleet in favor of the fuel-efficient, lower-maintenance A20. This isn't just a one-quarter fix. This is a structural commitment to lowering unit costs moving forward. This operational stability provides the necessary foundation for the stock to absorb that debt.
I'm not entirely convinced that internal efficiency is the core driver of the current optimism, though. I think it is the external capacity removal, as you mentioned, that makes the biggest difference. And the origin of that capacity removal is, well, it's profoundly ironic, and it demonstrates just how fragile this benefit is. Let's just recall the context here. The Department of Justice blocked the Spirit merger, specifically to preserve competition and protect consumers from higher prices. Yet, the resulting financial distress and Chapter 11 filing by Spirit created precisely the capacity constriction that the DOJ had sought to prevent.
The regulatory paradox?
Exactly. The regulatory paradox. It means JetBlue is now benefiting immensely from a catastrophic industry event, a competitor's effective collapse that it cannot control, it cannot replicate, and it certainly did not design. This is a one-time, market-driven gift that dramatically inflates RASK expectations. And while that's beneficial now, it doesn't demonstrate a sustainable strategic competitive advantage built on superior routes or cost structure over carriers like, say, Delta or Southwest.
I see the structural argument, I do, but you're overlooking the powerful technical implications of the current market structure itself. Even if we accept the benefit as a gift, the extremely high short interest, over 20% of the float, has created what is essentially a powder keg for those betting against the stock. With the days to cover figure now approaching 5 days, it means it would take 5 full days of average trading volume for those short sellers to close their positions. I mean, this high metric indicates extreme pressure.
So you're arguing for a short squeeze then?
Precisely. Any genuinely positive catalyst, an unexpected acquisition of attractive Spirit assets out of bankruptcy, maybe, or even a strong forward guidance update, could trigger a massive forced unwinding of those short positions. And the technical action we saw in December, where the stock decisively broke resistance at 465, showing what technical analysts call a golden star signal where the short-term moving average crosses the long-term, well, that suggests that momentum traders are already anticipating this forced covering.
I would caution very strongly against framing that high short interest purely as directional speculation. It's just too simplistic. Given the highly leveraged nature of the business, that $9.42 billion debt load, it is far more likely that a substantial portion of those short positions represent sophisticated institutional pair trades. These are strategies where funds are, for example, long United or Delta and simultaneously short JBLU. They're designed to capture the performance spread while hedging overall industry risk. They aren't necessarily betting on imminent bankruptcy. They are betting on JetBlue underperforming global carriers because of its capital structure weakness. And what's more, the quick price action you attribute to momentum trading is heavily fueled by retail sentiment on speculative platforms.
I mean, the stock is viewed there as a high-risk lottery ticket based on theories like the Nealman prediction, this idea that Spirit and Frontier will eventually merge, further consolidating the ULCC space. That is speculation, not institutional validation.
But speculation can create real market forces. Let's refocus on liquidity and strategic value, because those are key ways to overcome that institutional skepticism. While the debt is high, liquidity is robust. JetBlue ended Q3 2025 with $2.9 billion in liquidity. That is a substantial buffer, representing about 32% of their trailing 12-month revenue. This provides the necessary runway to execute the A220 fleet transition. which is absolutely critical for future cost control.
The liquidity is indeed a critical safety measure, but its sheer size also just highlights the magnitude of the potential downside they're defending against. It's a requirement, not a bonus.
Okay, but what about the strategic revenue drivers? The Blue Sky partnership with United Airlines, which allows TrueBlue members to earn and redeem miles across United's global network, is a significant long-term win. JetBlue historically lacked global reach, making its TrueBlue program less sticky than those of legacy carriers. This partnership drives higher margin loyalty revenue and sticky cash flow from their credit card partner. I mean, this is a foundational step toward diversifying and improving long-term revenue health away from just core air travel.
That partnership is certainly beneficial, but it doesn't fundamentally change the perception of the equity stability. Which brings me to a structural point we really need to address: the psychological pricing. We have to clarify a persistent confusion among retail investors that undermines confidence in this equity. JetBlue has never executed a reverse stock split. This low share price, the fact that it trades under $5, is not the result of manipulation. It is a reflection of real, fundamental value destruction over time due to operational losses and high debt accumulation. This reality underscores why the stock is still psychologically priced as a penny stock, meaning it carries a severe discount based on historical fundamental woes, regardless of a single quarter's operational improvements.
I agree the price history is painful, but if the market successfully recognizes the improved operating leverage from the A20 transition and the yield benefit from the capacity constriction, that psychological barrier can be easily broken. We are debating whether the operational fundamentals are finally strong enough to bear the structural debt load, allowing the stock to trade based on future earnings potential rather than past mistakes. I believe the evidence from the Q3 operational beat and the competitive retraction supports the former.
Well, my position remains that JBLU is fundamentally a high-risk leverage play. Look, management has demonstrated operational credibility in Q3 2025, and they are enjoying the temporary uncontrollable benefit of Spirit's troubles. However, that $9.42 billion debt load makes the underlying equity far too volatile for a sustained bullish thesis based on a turnaround. The risk of a low-probability, high-impact event, say a sharp liquidity crisis triggered by a sustained fuel price spike combined with a drop in seasonal demand, is still substantial enough to justify the defensive institutional posture we see, particularly that persistent short interest. It remains, for now, a value trap with an excellent operational team.
My summary is this. The market is now correctly recognizing the success of the JetForward strategic pivot. JetBlue has effectively reallocated capacity into higher-margin leisure routes and demonstrably improved critical internal metrics like CASM ex-fuel and flight completion factors. The expected industry rationalization, spurred by the regulatory paradox, provides a tangible and clear path to yield expansion by removing irrational pricing capacity from the ULCC segment. And while it remains a high-risk speculative hold, we can't ignore the debt, the operational foundation is stronger than it has been in years, and the structural setup for a significant short squeeze is acutely primed for a breakout.
So I think ultimately, a comprehensive analysis of JetBlue's survival potential demands that we consider both the tangible, successful execution of the JetForward operational strategy and, at the same time, the deeply precarious market structure created by that colossal $9.42 billion debt load, and the highly shorted nature of the stock. Whether the recent price action is a true strategic validation or merely technical speculation, well, that will only be revealed by how well management navigates industry turbulence throughout 2026.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.